Hello investors. It's been a wild month for the markets. For the month of Jan, the Nasdaq was down more than 9%. Indian markets also were down, and we also had a bit of a tough time. As you know, we are trend investors. We tend to favor growth, and it was a bit of a tough time for growth stocks. So this month, what I'm really going to cover is the kind of turbulence that you're seeing in global markets. And what we are going to address is the growth versus value argument, and what we are doing as far as your portfolio goes, so that we are oriented towards the new trends that are emerging. We do foresee that there could be some activity in your portfolio in the next few months. So I just want to sort of update you, brief you, and bring you update with the thought process that is there and occupying our mind as far as your portfolio goes. So let me share a few graphs with you. The first graph that you see on your screen is a US 10-year treasury yield for over 30 years. Now this is what I consider the mother of all graphs. What you see is from 1980, the way US bond yields have moved. So you can see how they have moved from almost 13 to 0.55. This was in the COVID time. So what you see are these two blue parallel lines, and how systematically bond yields have been declining for the last 32 years. Very well compressed or playing within these two blue lines. However, towards the right bottom, you'll find that it broke the lower channel and went to 0.55. This was the COVID fall, and this is when the US Fed further went on and aggressively pushed on the pedal. And what you see right now is nothing that bond yields are coming back. Yes, they touched 1.80 or thereabouts, but this is nothing but the excesses that happened during the COVID fall getting rectified. So you'll see that bond yields are again come back into the channel. Clearly, there is a lot of chatter and a lot of talk and thought process that the whole interest rate cycle has turned. We don't think so. What we think is that nothing else but the correction of a sharp fall that happened in the last 2 years or 2 years ago is getting corrected, and we are getting back into the channel. For me, the worry point will be if bond yields go above 3%, which is where the upper blue line is placed. So this really gives you a global perspective of what exactly is happening in global bond yields. It's not about tomorrow's headlines or day afters. We are talking about 30 years plus. We are talking about a super cycle in interest rates. And this has really been the biggest fuel, single fuel for equities as an asset class. Next, let me take you to the argument of growth versus value. Now, what are growth stocks? Growth stocks are nothing but those stocks which tend to grow faster than the broader market, and the market rewards them with a higher valuation. They have higher P's. They tend to be very often priced above fair value. And what are value stocks? Value stocks is nothing but stocks which have valuations which tend to be lower than their fair price. That means there is value to be made or bought if these stocks are bought below fair price, and that is value stocks. So what we see on your screen now is nothing but a ratio chart. A ratio chart is the relationship between growth and value. So post the 2008 financial market crisis, here also you will see that value has underperformed growth. In other words, growth stocks have done much better, and you can see this relationship moving up all the way from something like 0.8 to 2.26. And in the last 2 years, you'll find that there has been a bit of a wobble. From time to time, value does outperform growth. You can see that it's not a straight line, and we are seeing that kind of relationship playing out at the moment. So this really is an understanding of growth versus value. Again, for all the arguments and discussions, it is not that it is the end of growth and it's only value. These are ups and downs that keep happening. Few months belong to value, but most months, as we've seen in the last 12 to 13 years, have belonged to growth. And that is really again the larger picture that there is. Let me take you to the next chart. This will simplify your life a lot more, because growth and value are very, things people like us who are in the markets all the time look at. But from your point of view, let me put it very simplistically. Let us look at Nasdaq versus Dow. Nasdaq, as you can see, is a technology driven. It is a very good representation of the growth index. Dow is nothing but the industrial stocks, and this is where you very often find value. So now what we have done is, for the same period as the previous slide, 14 years, we have done a ratio between Nasdaq and Dow. And you will see that the chart looks very similar. So when you wake up in the morning and you see that some days, Nasdaq is down 2%, but Dow is flat, it is not, you don't know whether the markets are up and down. But essentially what has happened is that growth has come down and value goes up. And this is the kind of narrative that you are seeing. But here too you will see that the Nasdaq has outperformed the Dow since 2008. And yes, we are having a wobble at the moment. But this is not a trend reversal. It is not a change in direction of trend. And this is, as I said, long-term charts which will give you a very good understanding of how things are panning out. Now let's go and crunch the whole thing into that box, that green box you saw. This is nothing but that green box. Dow versus Nasdaq, and this is more in the recent times, which is the COVID fall. So what you will see is that March 2020, when we had the fall of COVID, the work from home stocks did very well, the tech stocks did very well, and you'll find that the Nasdaq outperformed the Dow. However, in Jan-Feb, exactly a year ago, you found that interest rates in the US, the bond yields went to 1.74, and you realize that how value came back, or in other words, growth underperformed, or the Nasdaq underperformed the Dow. However, by April, May, again it was back to growth, and growth stocks again revived, and that is when you saw a big revival in global markets. What you are seeing again in the last 2 months is nothing but a slight decline or relative underperformance in growth, and this is where we are today. This is what the month of January is a representation of. So when I say the Nasdaq is down 9% plus, this is a month when even the Dow has fallen less. It's not that the markets are down, it is just that growth has relatively underperformed value. So the markets are bouncing around. There's no massive change in trend as we see. These are nothing but corrections of excesses that have happened in the last 2 years. Let's take this further and bring it down to how we see things panning out in the future. What you see is something called the Commodities Index. It's also called the CRP Index. This is a summation of 19 commodities. So this has got gold, silver, crude, zinc, agri, you name it. They're all there, 19 of them. Just as the Sensex is a composition of many stocks, or the Nifty is a composition of 50 stocks, this is a composition of 19 commodities. And you'll clearly see that since 2008, again 14 years, commodities have been in a secular downtrend. However, you will notice that the blue line has got violated in the last few months, and commodities have rallied up. Now this has happened due to multiple factors. The factors are essentially, one very big driving factor has been the price of crude, and crude is very, very important for India, for your portfolio, because of the whole, the Russia issue that's happening with Ukraine, or for the Saudi politics with the US, and there are multiple other variable factors. These are factors which you and I don't have control on. These are factors where nobody has the perfect answer. But you will clearly see that the rise in crude and other metals, etc., have led to a rise in the commodity index. Now, as we see that it's not that there has been a demand explosion. Yes, restart has happened, but it's not been a demand explosion. It is just that coupled with these factors, we also have some supply chain issues, because a lot of people have not got back to work. So the ports tend to be jammed. A lot of manufacturing plants take time to restart. So we also see that these are some issues that are with supply chains. So our understanding is that yes, commodities have gone up, but it is not going to be a permanent, long-lasting thing. As things settle down, as geopolitics settles down, we feel that commodities are not going to be a runaway freight trade. It's very difficult for anyone to take that call. Obviously, we don't know what's going to happen between Russia and Ukraine. Nobody knows. I mean, even the US president doesn't know. So who are you and me to discuss that? So really the issue comes down is what we are planning to do with your portfolio. So what we find is that in our portfolio, we have a lot of stocks that are sensitive towards crude. Crude is a raw material for a lot of our specialty chemical and paint stocks. And obviously we've seen that as crude prices went up, the price of derivatives go up, and this leads to compression of margins. So as the quarterly numbers are coming, we find that. So what we are trying to do in this quarter, or the numbers that are coming out, is trying to differentiate between those companies that are able to pass on this hike of input cost. Just because your raw material cost goes up, it's not a problem. If you can pass it on to the consumer, it's all good. However, if you're unable to do that, or cannot do it that with a lag, then it becomes a problem area. So what we are really doing is getting down to the drawing board in the new reality of commodity prices going up, of the market favoring value versus growth in the short term. We are going back to the drawing board. And we see that, in your portfolio where we have done nothing last year, we sat on other winners and been a placid one, we foresee some activity coming up. We feel that certain trends are changing, and as trend investors, it's our job to adjust the reality. As I said, we cannot preempt. Nobody knows what is really going to happen with the whole commodity play. But at the same time, this helps us to do a dipstick and see the quality in our portfolio, to see stocks which have moats, which have pricing powers, and continue to hold them in spite of short-term difficulties. And wherever we find that their managements, companies, products are unable to pass it on, and it puts a question on the quality of stock we hold, we would be very, very quick to move on to some new themes. We are definitely researching. We have some very interesting themes, very unrelated themes that are popping up. So a lot of research, a lot of work is going on, and I do foresee that in the month or two, of course, we will definitely keep you informed. You will see a little bit of churn in your portfolio. We need to align with the trend, because at the end of the day, we are trend investors. With that, I leave you for this month, and this is going to be a month of hard work for us, but we are always there, focused on the market and keeping your interest ahead of anything. Thank you.